Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bond traders raise their bets on a jumbo rate cut. 50 basis points could be in play. More data on deck today. A brief disinversion in the yield curve. Softer jobs data challenges the Goldilocks narrative. And to Washington, VP Harris unveils her capital gains tax plans as POTUS gears up to block a foreign takeover of U.S. steel. Good morning, Manus.
Danny, good morning. There was a powerful readjustment to risk yesterday, and it centered on the bond market, down by 10 basis points at the short end of the curve, as the JOLTS data came in softer than everybody expected, and that appraised the rates market. Down went the bond yields. Equities are struggling with their own issues in terms of what size of rate cut will we get. Tesla's up this morning. We'll talk more about that. Their self-driving package potentially coming through in China and in Europe. But it was this rates redux that really we've got to try and grapple with. Jobless claims today, along with the ADP. And that powerful re-rating on rates, Danny, drove the dollar higher and the yen lower. So again, this is about a narrative of where will the curve go to. A brief moment of disinversion yesterday. Good morning.
Driven by what? JOLTS data that we know the survey rate is low, that we know is backwards looking, that captures that July period that we already knew was weak. We're in this period where we're so sensitive to each point of data, and it is the Fed themselves that are underscoring this behavior from the markets. Mary Daly speaking to Reuters late yesterday, and she was asked, what are you going to do, 25 or 50? Her answer, we're still collecting data. We have a labor market report. We have a CPI report. We have all of our contact information. 2 weeks away from a decision, and they're still waiting for the data to tell them what to do.
If we take our mind back to Jackson Hole of when Powell said any cooling in the labor market would be unwelcome. So I think the focus as we go to Friday is going to be on the jobless, the percentage of unemployment, because that takes us back to the SAM rule. And I like what a couple of people are saying is, look, if you've actually got to cut rates, cut when you can, not when you need to. And that's a really important narrative.
Well, that's been the criticism of the Fed, right? That they have been able to cut and they haven't. But again, you keep hearing from Fed officials, and Mary Daly says this in her interview, too, that their constituents, when they go out and talk to people, inflation is still a concern. So you can see them still wanting to hold back. Yeah,
the data probably says that's in the rearview mirror, that the street is yet to actually really catch up with that. We are waiting for more hints on the U.S. economy today. Here's what Oaktree's Howard Marks had to say on the Fed's rate path. The Fed will back off from the emergency rate of 5.25%, 5.5%, and get to the threes. My belief is that we're going to stay there in the threes, and we're not going back to zero or anywhere near that. Joining us now is our cross-asset strategist, Ven Ram. Ven, good to see you this morning. I mean, Danny and I have just talked about this jolt in the Treasury market and the moment of disinversion. How will Treasuries fare out of this series of rate cuts? Some people are saying to me, you may even see a pop in rates on the first cut.
Absolutely. I think that, Treasuries are kind of overpricing how much the Fed is likely to do. I mean, based on current indications, as you said, there's plenty of data still to come. So the field is wide open for the Fed to go bigger. But assuming that the Fed goes only 25 basis points, there is room for correction in front-end treasuries because they are already pricing in a lot. Now, I would like to go back to that quote that you cited of Mark. I think that I agree completely with him, and I think that we should be prepared for a 3-point-something rate from the Fed, because if you pass the Taylor rule rate, Manus, what it shows is that the Fed has room to cut rates by 215 basis points. And I think even if they don't go all the way to 215 basis points, they can cut by, say, 200 or 175 basis points from here, which would take you to about 3.5%. So I think that investors should be prepared for that kind of terminal rate.
And that's pretty much what's priced in over the next year, Ven. Ven, there's also been this really wonderful debate on the Markets Live blog about whether or not we should care about a yield curve disinverting. It did it for the second time intraday yesterday. How much should we care?
Well, I think we should pay heed to what is coming from the yield curve disinversion, because the yield curve is disinverting for a reason, and that is the increasing wobble in the labor market that we are seeing. There's no doubt that the labor market momentum is cooling and the economic cycle is aging, and increasingly the cracks are appearing to show. So I would err on the side of caution here rather than say that it doesn't matter at all.
Fair enough, Ven. Appreciate it. As always, that's Bloomberg's Ven Ram. Let's now bring in Henrietta Pacquement. She is the head of global fixed income at Allspring. Henrietta, you look at this bond market and you say that there is an aggressive amount of cuts priced in, with at least 150 basis point of cuts through the end of the year. Is there anything that you could see on Friday that to you would turn it from being aggressive to justified?
Well, they are going to be watching the data, as we are. You talked about the jobs data, you talked about the inflation data coming up. They're going to be looking at it. At this point, though, it does feel like the markets are pricing a pretty aggressive end to the year in terms of cuts. We're looking at about 1%, with that hesitation between 25 and 50 at the upcoming meeting. So if you look at 1%, that means that we need at least 150 basis point cut at some point, because we have 3 meetings left. So it could be this time, and I think that will depend on the data that we see over the next few days.
Henrietta, tell us this. Good morning. We can get to what it is that shifts us to 50 basis points in a moment. The disinversion twice in the space of 6 weeks in the curve. How ominous is that?
Well, I think we're coming out from an extraordinary period, and I think some of your commentators this morning mentioned that. We have come out of the pandemic period. We have come out of a period of high inflation. As a result, that explains why we have the rates we have at the front end of the curve. So, in a way, this disinversion is more of a normalization, particularly if the central banks manage to engineer this sort of soft landing that we're in at the moment.
It might be just normalization, Henrietta, but there has been a sense of maybe panic is too strong, maybe a little mini panic. On Tuesday, what you saw with both equities, yesterday, bond markets. Through it all, credit has been so resilient. Sure, spreads widened ever so slightly, but some $43 billion, the third most on record, priced on Tuesday. You had another $30 billion just about priced yesterday. What do you make of the resilience of the appetite and the ability for corporates to still issue into the volatility?
I think that's really positive. Obviously, companies are able to fund themselves at this point in time, and you do get that investor appetite. And I think that's linked to fixed income assets in general. I think they're starting to behave as you expect them to. They're particularly on the rate side. You're seeing that diversification element. We saw it in August. We've seen it again in the volatility that we've seen in the last few days. And I think that is giving comfort to investors there. If you look at the spread side, yes, I mean, they are reflecting the benign environment that we're in at the moment. Yes, you had a bit of widening, but as you say, it's not that much. And credit markets have been very well behaved. So I think those are the sort of drivers that we're seeing. Enthusiasm for fixed income again at this point in time, particularly as we expect short rates to go down again. That boosts the attractiveness on the sort of longer fixed income side.
Henrietta, you've moved to tactically long. We are seeing a move a little bit more defensive in equity markets. Where is the defensive play on the curve? If the short end has moved so aggressively, is it the belly of the curve for you?
Yeah, I think the intermediate part is an interesting place because it does sort of tend to move around and gives you a bit of opportunity from a capital appreciation perspective, and you get a bit of the yield without sort of necessarily going too long out on the curve at this stage. So yes, we quite like that area of the curve.
With that attractiveness, and you say that it's more wide, people are more interested in fixed income. Is it enough to finally eat into cash holdings? Because, Henrietta, we've heard from so long about the reinvestment risk at this period. Are folks finally starting to wake up to that?
Interesting question. I think we're going to have to see the first cut for that to happen, I'll be honest, and then they'll see that it's real. So I think we're very close.
Look, we're seeing some shifts across asset allocation, pulling out of tech and equity. When you look at the flow into credit and bonds, how would you describe the structure of the market at the moment?
We're certainly seeing a lot of interest from institutional investors at this point, and reallocations in their portfolios there, and a sense of looking for that diversification, looking for income as well, and looking for diversification in terms of their fixed income allocations as well. So they're not necessarily putting all their eggs in the same basket. They are looking around the fixed income markets for opportunities and benefiting from that diversification.
What difference does it make to them when you have a bond market that has been quite volatile? You have a front end that can move more than 10 basis points on JOLTS data, which is usually the staid, calm part of your portfolio. How does that change allocations when all of a sudden you're faced with more volatility?
Ah, come on. The real volatility test was in 2022. At the moment, yes, it's moving around, but I would argue that it's a much smaller range. And you have much more of a cushion from an income perspective. So I think that's the attraction on the fixed income side, and that's very different from the sort of real volatility that we saw in 2022.
Henrietta, we started this conversation with Van, our correspondent on the bond market, talking about where the destination was. Oaktree with us, that quote from Oaktree, we're going to end up in the threes. The Taylor rule says that you can cut by, 215 basis points. If Goldilocks holds, what kind of cycle are you now estimating if you're tactically long?
At this point, I think that's what we're seeing as positive is that central banks have got a lot of ammunition in their conventional tools. And that's very different from what we had post-financial crisis. So we see that as a good thing. Obviously, they need to be careful in how they yield it, but it means that they've got room to cut over the next few months. So we think that we're going to be in between what we had post financial crisis. We don't think we're going back there. We don't have the sort of leverage and conditions for that at this stage. But equally, we're probably not going back to the sort of days pre-financial crisis where you had a higher neutral rate. So somewhere in between and around 3% doesn't sound like a bad place to land if we keep the sort of growth prospects that we've got at the moment.
A lot of mortgage holders would be happy if we can get to 3%.
Exactly.
Exactly. It would be welcomed, I'd say, globally. Henrietta, thank you very much. Henrietta Pacquement, Allspring Global Investments. Other stories trending on your Bloomberg terminal this morning. Tesla plans to launch its full self-driving in China and Europe in the first quarter of next year. Tesla AI, it's an affiliate of Tesla, says FSD, as the company likes to call it, will roll out pending regulatory approval. The company got approval in Shanghai to test the system earlier this year.
Samsonite has selected JP Morgan and Morgan Stanley for its dual listing in the U.S. The luggage maker is hoping to improve its liquidity, draw more investment globally. Now, other banks are looking to join the lineup. Samsonite currently trades in Hong Kong, but it may make the U.S. its primary listing.
The London Stock Exchange has said that Burberry will be dropped from the FTSE 100, ending a 15-year presence on the benchmark. The luxury British fashion house, with its distinctive beige check worn by celebrities like Billie Eilish and Lewis Hamilton, has a capitalization below the level required after its stock declined by more than 3/4 since hitting a record. That was April last year.
If Lewis Hamilton can't save it, then nothing can. Coming up, Nippon Steel's takeover of U.S. Steel is in jeopardy. President Biden is preparing to block the deal. We're going to have more on that next.
And later in the hour, 25 versus 50, we speak to HSBC's Nicole Inui on the Fed's rate path. Context matters on Bloomberg. It's Bloomberg Brief. I'm Manish Krani alongside Danny Berger in New York. President Biden said that he's preparing to block Nippon Steel's $14 billion takeover of U.S. Steel. U.S. Steel responds with a statement in writing. We continue to stand by the fact that there are no national security issues associated with this transaction. We fully expect to pursue all possible options under the law to ensure this transaction. Nippon Steel, they stood by the deal as well. We have been clear with the administration that we do not believe that this transaction creates any national security concerns. Kriti Gupta is with us. This is going to turn into and is a hot political issue, Kriti. U.S. Steel are warning that thousands of jobs could be at risk if this deal doesn't go through.
Manis, this is an American manufacturing institution founded by none other than JP Morgan itself. The bank and the man for that the bank is named for as well. This is the company that has provided the steel of so many American bridges, American landmarks, not to mention a lot of the steel that is still there as a part of New York City. This is why it's a concern, though. This is a company and a sector, by the way, that has been bleeding employees, bleeding market share since its heyday back in the 1920s. The problem here is that they really need this takeout offer to stem some of those losses, and that's where you're seeing a lot of pushback, to your point, from the political landscape. The idea here simply being that this could be a deal that sets the precedent not just for the manufacturing sector and not just for U.S. Steel, but for other takeover offers as well from international companies for American companies, whether that's U.S. Steel, whether that makes up a big chunk of the economy or not. And this is, of course, something that's already seeing a lot of pushback from the likes of the Rust Belt, where Kamala Harris and Donald Trump are both trying to win over some votes. I should also mention this is crucial in that U.S. Steel has already made the comments that if this deal does not go through, they're already talking about closing plants and laying off even more workers.
Well, speaking of pushback, there have been many in the investment community, and Axios reports this, that the PACs have been getting more money from the investment community, specifically private equity, towards Republican candidates throughout the ticket versus Democrats. And part of that is about taxation. And Vice President Harris spoke about part of her economic plan and taxation at a campaign event in New Hampshire. Take a listen.
If you earn $1 million a year or more, the tax rate on your long-term capital gains will be 28% under my plan, because we know when the government encourages investment, it leads to broad-based economic growth and it creates jobs, which makes our economy stronger.
So more than the current rate, less than Biden had proposed. What kind of picture is she trying to carve out, Kriti?
She's trying to basically assure the business community, the economic community, that she is a markets-friendly and a business-friendly leader. And this is coming, of course, on the heels of a lot of pushback from economists, from market participants as well, that her comments around things like price gouging or addressing price gouging or putting caps on things like housing affordability, or even to continue some of the acts that President Biden has talked about in terms of things like drug care pricing, will not actually be stagflationary. That is the criticism that she's fighting, not to mention that the Republican Party is largely considered a more market-friendly party. This is significant as well because you made the point that she's coming in with a 28% plan that is significantly less than Joe Biden's proposal. Joe Biden pushing as high as 45% on that capital gains tax rate, of course, at the discretion of whether or not Congress approves it. But this is also significant because it is an increase from the current 21% that we have right now, and could, to Kamala Harris's point, encourage or make or break the appetite that you're seeing for investment. This is a way to appease some of the voters, bring some of the Republicans on her side, and also to reassure the financial community that she may actually be a positive when it comes to those policies.
Kriti, appreciate it. That is Bloomberg's Kriti Gupta. Okay, let's get a quick check on commodities this morning, because, Manus, there is a slight whiff of an attempt to come back, not as forceful as you would hope, considering crude had just fallen to its lowest level, I believe, of the year yesterday after a big sell-off on Tuesday.
Yeah, and look, we had this story yesterday that OPEC Plus may reconsider the amount of oil that they're going to put back into the system. And of course, look, you know, they backtracked on that as soon as they announced it. It can be paused or reversed at any time. So I think that that's the narrative that maybe just creates a bit of a floor. You check out gold, obviously, still around that 2,500 level, but lots of views in terms of China growth coming through as well. Lots of cuts coming through over the past couple of weeks.
Yeah, it's dourness about China growth. It's also concern about supply coming back on the market with Libya. And as you say, whether or not OPEC will actually pull back on some of their supply. We're going to talk about China demand coming up, specifically in luxury. Tiffany's is shifting gears. They are downsizing. We'll have that next for you on your brief. It's Bloomberg Brief, Danny Berger and Manish Cranny in New York. Let's get you some front page news, a look at what's making headlines around the world. First up on the New York Times front page, Liz Cheney has officially endorsed Harris. Of course, she's been very critical of Trump for some time now. She was a Republican House of Representatives member from Wyoming previously. She now joins Adam Kinzinger, the former Illinois congressman, and Jeff Duncan, the former lieutenant governor of Georgia, as Republicans endorsing Harris.
Yeah, and she talks about as a conservative and someone who believes and cares deeply about the Constitution. Interesting kind of nuance there from her. Next up, we've got the Financial Times. US and Britain and Brussels, they're going to sign an agreement on AI standards. A big shift here. It requires more than 50 signatories to be accountable for harmful and discriminatory outcomes of AI systems and provides legal recourse for the victims. Now, the companies worry that a patchwork of national regulations could hinder innovation.
Wonder what Musk has to say about that. He's been calling for AI regulation for some time now. Now, finally, as Mana spotted this one, Tiffany's is planning to downsize a flagship store in Shanghai. It is more than 12,000 square feet. And Manis, the company just points to weak China spending, a story we've heard over and over again.
Look, I think this has a global reverberation. Of course, Louis Vuitton took over, Tiffany's here in the US. But look, it was a fanfare in China, and they've asked for a 50%. They're going to halve the footage, and they've asked for a discount from the landlord. It's tough in hard luxury. Hard and soft luxury is going through a pretty tough time.
But it's all China. I mean, there's been so much dourness about China. JP Morgan, the latest to downgrade stocks in China, saying the impact of a potential Trump War 2.0 could be worse, saying that it could be more significant than the first tariff war.
And that takes you back to a host of downgrades on growth. Last week, we covered this. UBS have a 4% growth target for China going into next year. Yeah, they're shaving back this year, but let's face it, there's 3 months left of this year, and the iron ore market pretty much tells you everything you need to know about the outlook there. We're going to talk to HSBC in just a moment. Your equity outlook on Bloomberg Brief.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger, alongside Manish Cranny. Let's set your agenda.
Bond traders raise their bets on a jumbo rate cut. 50 basis points could be in play. More data on deck. A brief disinversion in the yield curve. Softer jobs data challenges the Goldilocks narrative. And to Washington, VP Harris unveils her capital gains tax plans as POTUS gears up to block the foreign takeover of U.S. steel. Danny, good morning. It's a normalization of this curve, according to Henrietta, not an ominous sign.
It might be normalization, but it still feels shaky. It still feels fragile. If we can react so much off of JOLTS data, we fall again today in the pre-market session for U.S. equities, but barely, down about 0.1%. All things considered, considering what happened in the bond market, we weren't too negative yesterday on S&P futures, down by about 0.1%. Two-year yields, those little change this morning, 3.7%. As you say, Manis, a very brief disinversion, but we are now almost at even odds of a 50 basis point cut come 2 weeks from now. It all depends on the jobs data, but one thing certainly helping the long end has been what's happening in commodities. Crude up again 1% this morning, but before that down for 4 consecutive days to the lowest level since June of 2023, Manis.
Well, Danny, the narrative about this jumbo rate hike, I mean, it was a really outsized move and response at the short end of the curve, down by 10 basis points. And the Fed were so reluctant to, get on the hiking track. It just raises the question whether Powell really will be able to galvanize the committee into cutting that hard, that aggressively. And as Henrietta said, this cutting cycle, or what's priced in, is quite aggressive for her at the moment.
I just wonder what the politics of cutting 50 basis points in September, right before an election, would look like for the Fed, especially if it's not a unanimous decision. Sure, we have more Fed officials saying that they want to cut, that the market looks ripe for it, less so saying 50. The language has been gradual and taking their time, Manis.
Yeah, I mean, look, the other ominous sign that we had yesterday was this disinversion. I mean, lots of people were saying it was an ominous sign that you had this disinversion in the yield curve. Henrietta Pacquement saying, no, it's a little bit more normalization. Well, history might show you something a little bit different. But let's talk a little bit more to our guests. We are counting down. We had the jolt yesterday. We were jolted by the JOLTS data, excuse the pun. The markets are counting down to the jobless claims later this morning and the payrolls report, as Danny has been saying, on Friday. What does it take to move them? Our guest this morning is Nicole Inui, head of America's equity strategy at HSBC. Nicole, good to see you. There was a powerful repricing in the short end and across the curve yesterday in the bond market. That challenges the Goldilocks narrative from an equity perspective. Are you jolted? Are you a little bit more spooked about the Goldilocks narrative?
So, we still have the base case that we're going to have a soft landing scenario. We don't expect a recession in the U.S. We're expecting 3 Fed rate cuts, 25 basis point each. But really, the focus is going to be on this jobs data on Friday. We don't expect a deterioration. We expect unemployment to actually improve a little bit on Friday. But if we do see this deterioration similar to what we saw last month, I think that will definitely spook the markets a bit. I think that will push the markets think that the Fed should cut 50 basis points. So I think, really this is what the market is focused on Friday, the jobs data. But, again, what we're seeing is a slowing in the labor market, a slowing in the economy, and really not this, a breakdown in the consumer or fears of a recession. So, that's still our base case. But, I think this market is extremely data dependent, really reacting on just single pieces of economic data coming out. But really that remains our base case, which is very positive for equities at the end of the day.
Yeah, it's this feeling of trying to find a new trend, Nicole, and we're so volatile as we do that. And in that trying to find a new trend, Scott Rubner of Goldman Sachs says that on Friday, should the jobs market data be weak, it will be the start of a correction in equities, because a weak data point would meet seasonality, would meet with positioning, would meet with a blackout period for corporates. I just wonder what you make of that call. Could there be a correction among equities if there's a weak report tomorrow?
Well, I think the market is definitely very skittish, very jittery. So, we've seen this roller coaster ride over the past month, where we saw a huge sell-off after the weak jobs report a month ago, and then we saw a very quick recovery. So one of the fastest recoveries we've seen since such a sharp sell-off since the beginnings of the pandemic. So, I think definitely if it's weak, the market's going to react to it. But, at the end of the day, when you're looking at equities, you're looking at corporate profit growth. And what we saw in the second quarter was a very good earnings season. We saw a lot of companies beating on estimates, almost 80%. And the guidance that the companies is giving was still positive. So, we're going into kind of this third quarter with expectations okay. The company guidance is pretty good. And remember, the market is already expecting a significant slowdown in GDP growth in the second half of the year. And so far, the second quarter, we saw excellent GDP growth. So I think there is room to surprise if GDP comes in better than expected. And that would mean room to surprise also on earnings. So again, I think we will go into the next few weeks a lot of volatility, not only looking at once the Fed cuts, the question will be, okay, well, what's going to be the magnitude of this Fed easing cycle? And then, of course, we go into elections and other things that will bring volatility to the market. But at the end of the day, I think corporate profit growth should stay pretty strong.
Well, look, one thing is when you take out the Mag 7, the earnings in the rest of the index were healthy, you say, up 9% year on year. Probably one of the best quarters that we've had since when? Since 2022. And this plays to a narrative Danny and I have talked to a lot of guests about whether it's time to become a little bit more defensive with those kind of earnings and rotate. Is it too late, or do you actually take action now to go defensive?
Yeah. No, I think you go defensive if you're worried that we're going to get a recession. And, we've written about that. If you're worried about recession, you go into staples, you go into healthcare, maybe you go into software. There's certain sectors that if we go into recession, we think that they'll stay pretty resilient. But what we're expecting now is really, since we're seeing this broadening of earnings growth. So, it's not just a tech play. You're seeing financials, you're seeing utilities, you're seeing healthcare growing at similar earnings growth rates than ads tech. So we think going forward, you should be positioned into being more, broadening your exposure to other sectors within the S&P. It's going to be less just a tech-focused rally, and we're already starting to see this. And again, if the economy stays strong, stays resilient, we have no recession, Fed rate cuts, that's a very powerful combination for equities. And in the past, you usually see the S&P rally when we have this sort of scenario.
Within the consumer sector, though, Nicole, there have been strong earnings And there have been very weak earnings. Dollar Tree yesterday fell some 20% after cutting their outlook, following their peer Dollar General in doing that as well. Looking at these discount retailers, can you take any macro stock-wider signal from them, or are these isolated idiosyncratic earnings?
Yeah, so we've written a lot about the consumer, about the K-shaped consumer, about the high-end consumer still performing very well, the low-end consumer struggling. And within the consumer sector, you need to find kind of these pockets of strength. So, you have a certain situation where some companies focused on a low-income consumer is underperforming, but you have other companies that you're seeing they're benefiting from a trade down. So they're benefiting from a middle-income consumer trading down. They're benefiting from share gains. They're benefiting to have more traffic into their stores. So within consumer discretionary, it's really a stock picker's market to find those areas of consumer strength, those pockets of consumer strength. And, I think when we start to get rate cuts, those areas that have been weak within the economy, so, the housing sector, the low-income consumer, I think those we can expect to see a little bit of improvement as rates come down, because that will give some relief to where we're seeing weakness within the economy, within the consumer specifically.
Nicole, really wonderful to get your thoughts this morning ahead of a very important day tomorrow. Nicole Inui of HSBC. Coming up, shares of U.S. Steel slowly climbing back after a double-digit plunge yesterday. We're going to have more on President Biden's plan to block Nippon Steel's takeover bid. That coming up next. Welcome back to Bloomberg Brief. I'm Danny Berger alongside Vanish Cranny in New York. So President Biden is preparing to block Nippon Steel's $14.1 billion takeover of U.S. Steel. That, according to people familiar with the matter, U.S. Steel responded in a statement writing, quote, "We continue to stand by the fact that there are no national security issues associated with this transaction. We fully expect to pursue all possible options under the law to ensure this transaction." Nippon Steel standing by the deal, too, saying, "We have been clear with administration that we do not believe this transaction creates any national security concerns." Joining us now is Bloomberg's Derek Wallbank. Derek, it's not only those statements, it's also U.S. Steel saying that they'll have to let go part of their workforce should the deal be blocked. What is the political calculus behind this?
It's a tricky one, Danny, because you have to ask which part of the political calculus are you looking at, right? The first part of it is that Pennsylvania is arguably the most important swing state in the upcoming elections, right? Donald Trump has vowed to block this deal. Joe Biden's, as you quite rightly said, signaling that he would kill the deal if and when it lands on his desk. Okay, so both of those seem like they're in some alignment trying to go there. But then, as you say, there are these questions about consequences for the company. And that's not just like some random idle thing. I mean, you would have that sort of talk anyway. But you did see a pretty substantial market reaction, right, to this news. And so there is some real concern, I think, that there could be negative outflow effects if this is rejected. The second thing I've got to talk about, though, is that Japan is a partner in the Pacific for the United States and has been one of the key partners that the U.S. has been reaching out to in terms of, well, everything, right? Taiwan, in terms of the Quad defense partnership and things like that. And it's very, very difficult, I think, for the U.S. to make the case from a foreign relations perspective to the Japanese, who have grown ever closer to the U.S., that they all of a sudden, one of their companies would be a national security threat to the United States. I think that is a very difficult posture and it's a very difficult political diplomatic dance.
Yeah, well, certainly the digital transformation minister is already saying that they're all just hunting for labor union votes. So this could really have a whiplash effect in this campaign. But of course, we get more information. Vice President Harris, she spoke about the economic plan at a campaign event in New Hampshire. Let's take a listen.
If you earn $1 million a year or more, the tax rate on your long-term capital gains will be 28% under my plan, because we know when the government encourages investment, it leads to broad-based economic growth and it creates jobs, which makes our economy stronger.
Now, Derek, it depends which way you thread this needle. One could say her plan is less than Biden's. It's an olive branch, but it is up from 20% at the moment. So, again, it is a revenue-raising proposition. Politically, it's a solid vote winner in these swing states.
I mean, politically, Ben, so you got to look at it and you say, okay, am I willing to lose everybody over $1 million a year to gain people under $1 million a year? And math says that taxing the rich and soaking the rich is a popular thing to do. Now, I think one of the realities that Kamala Harris is looking at here is that among the Democratic base, certainly there is a view that a lot of the money that comes in at the higher income levels is coming in ways that are currently escaping the U.S. tax code, right? The idea that above a certain income level, capital gains are your chief source of income, right? Not actual salaried labor. And we can go through any number of executive compensation deals to sort of go at that point. The other thing that I have to mention here is that part of where this is getting additional resonance, right? You sit there and you think, oh, well, how would this get through Republicans in Congress? Remember that the tax code is being opened next year, right? There's so many expiring provisions in the last Republican-backed tax law that do expire, and there's going to be a very big negotiation about potential pay-fors. So what Harris is really doing here is not saying this is exactly what would go through, but sort of laying down on the table, this is one of the areas that we may go after. We may talk about capital gains on high-income earners, and yeah, maybe it doesn't end at 28%, but maybe putting it up is in play in order to pay for something else, because all of that conversation and all of the we'd love to do tax cuts for insert people here is going to play out against the backdrop of how much do you value deficit spending and that sort of argument. So all of this is going to go into the mix, and consider this like an opening bid with political ramifications that people who do have a lot of capital gains income and are in those higher income brackets will really be needing to pay attention to, particularly next year.
Yep. Well, at the moment, we're on the headline level. Let's see what translates. It's counting down to that election day. Derek, thank you very much. Derek Wallbank on the very latest from Kamala Harris's tax propositions. Another stock we're keeping an eye on is Tesla. Is planning to launch a full self-driving system, the FSD. In China and in Europe, it's going to be in the first quarter of next year. Tom McKenzie is with us. Tom, the rollout, I mean, they've had some trials, but this seems to be quite an announcement in terms of full self-driving on the European roads. I mean, do they have the political backing for this?
Yeah, look, this is really consequential. In terms of the details, FSD, by the way, full self-driving, Tesla admits this, it's not actually full self-driving. It's a level of autonomy that gets you closer to that. So the naming is a little off, but Tesla have acknowledged that. It's consequential because they charge about $8,000 a year for a subscription to this in the US. So it's a potential additional revenue driver for them, both in Europe and in China. The China part's really interesting. Elon Musk made a trip there in April. He was going to go to India and meet the Prime Minister Modi there. He decided to ditch that and go and meet the Premier of China instead to push for this and lobby for this. He's met a couple of tests in China. He's had to sign a deal with Baidu on the mapping component for this full self-driving autonomy. And he's had to come up with some assurances for China around data and privacy concerns, data security and privacy concerns. It seems like he has either met those, or they have either met those, or will be meeting those soon, because he's looking at that rollout in the first quarter of next year. So what do they get from this in that market? Possibly that $8,000 additional, depending on how they price it in terms of the subscription for this, at a time when, of course, they've cut the price of their models in that Chinese market. They've seen their market share go from about 10% to about 7% by the end of last year. The first 8 months of this year, they've seen sales fall by about 6%. So they need those additional revenues from their largest overseas market. They will be hoping that FSD and approval on that front will get them there.
Well, to that point, Tom, it's such a competitive market in China and Europe with the cheaper Chinese vehicles. To that point, Volvo Cars, we learned early yesterday, it's abandoning its goal for all-electric lineup by 2030. They also announced a profit outlook cut this morning, in part because of scaling back of EV goals. How do these EV makers stand up unless there's something like a Tesla that can offer a new product?
Yeah, Danny, I noticed you're wearing a nice and bright shade of green today. Volvo wearing a slightly murkier shade of green. They were really symbolic. One of the first companies to come out and say, we are going to be fully electric. They gave this target of 2030. They've now walked that back. Not hugely, but they give themselves wiggle room of around 10%. So they'll say by 2030, they'll be 90% of their way there. They may be 10%, which will be plug-in hybrid, so not fully electric. They've also walked back some of their emissions targets for their vehicles as well. And again, it's modest, but it's hugely symbolic given where Volvo were in terms of being first out of the gate in setting these targets and how essential it is for that business in terms of how they market and brand themselves. And it's a reminder of the slowdown generally in demand for EVs here in Europe, given, again, the competition we're seeing from China, the lack of support from the state. Will that change? One to watch.
Tom, I just need to clarify. My trousers are indeed bright green. I realize on the shot you only see my top, which is black, which might lead people to think you're colorblind, Tom, but he is not. Tom, thank you so much for that. Bloomberg's Tom McKenzie. Okay, coming up, we're going to set you up for your trading day on this Thursday. More data to come. It's Bloomberg Brief. Danny Berger and Manish Cranny in New York. Let's get you set up for your trading day on this Thursday. And it is a data-packed one, especially in the 2 hours, starting with ADP at 8:15 a.m. Jobless claims will come at 8:30 a.m. Then PMIs at 9:45 and ISM services at 10. Then former President Trump will be speaking at the Economic Club of New York. That happens at noon Eastern. Plus, we're going to get some earnings, specifically Broadcom, after the market close, Manis.
Never far from a little bit of an earnings sheet. In terms of the data that you mentioned there, Danny, let's get back to Ven Ram. In terms of the outlook, Ven, we're counting down to the jobs number, obviously, tomorrow, ADP and jobless today. Pretty powerful jolt in the response from the bond market yesterday to jolts. What are we going to be focused on today?
Well, I would be focused on the ISM services number for the simple reason the ADP number, as you know, is forecast to show an improvement. But if you look at it in the context of the recent PLS downward revision, the markets are likely to be skeptical about any improvement. So I would rather look at the ISM services number. I think that if that shows a weaker number, then the market's fears will be doubly compounded coming on top of the JOLTS report and ahead of the non-farm payrolls report. So I think the services PMI is what I'm looking at.
For people who like to look at asymmetry in this market, Ven, given the bond market rallied to start this week, given that equities sold off, how are we set up into these data points?
Well, I think that the risk is towards some profit taking in treasuries, particularly the front end. The front end has rallied a whole lot, and at 377, it's discounting the Fed funds rate by a whole lot and then some. And as for equities, they remain frothy despite the correction. I mean, if you look at the fair value on NASDAQ, it's somewhere around 12,000, and now it's trading, despite all the correction that we have seen, it's still, there's a 50% gap between its fair value and where it is trading. So I think that the traders are likely to take money off the table first and ask questions, if any, later.
Yep, shoot first and question later. Ven, and if you listen to Goldman Sachs, I mean, they're basically saying in the down market, these CTAs and the flow traders could tank $65 billion worth. So it is about momentum there as well. Ven Ram with the setup to the services number.
Yeah, they say a correction could start. Goldman, that is, if there is a bad number. Okay, that's it for your brief surveillance. That's up ahead here on Bloomberg.